Okay, let's finish out Chapter 6 because we're going to do a couple of problems this way. We often use capital budgeting as an attempt to determine whether or not we should undertake a project, but that's not the only time we can use capital budgeting. We may say, our company is struggling right now and we need to make some cuts. And what would be the present value of those cuts? And think about it. You've got an earnings call coming up and you want to be able to anticipate how the market is going to react to the fact that you're laying off 10% of the employees or that you're cutting the quality of your product. So those kinds of cost-cutting proposals can also be done. Remember, cash flow analysis is about incremental cash flows. So anything that you do that's causing your cash flows to change, either for the positive or the negative, becomes relevant. So the Baldwin example would cause your cash flows to increase in a positive way. You would undertake a new project, and that project would generate additional incremental cash flows for your company. Cost cutting often will say, well, if we lay off 10% of our employees, our cost will decrease by 6%, and therefore our cost now will be $60,000 per year. When you do that analysis, you often don't start with a sales figure. You start with the incremental cost impact. And we'll do a problem like that in a minute to help make that a little bit clearer. Sometimes you're trying to figure out how you should price things. We're looking at acquiring another company. We can project what we expect the cash flows are going to be, the synergies with this company. We can look at the cash flows that company is already generating. But how much should we pay for this company? Well, you can do an NPV analysis to figure out what price you should pay. And a number of times we're considering projects of unequal lives, and that's the one I want to talk a little bit about. If you remember when we did Euroland, you had the equivalent annuity number in there, and Euroland did that because you had 11 or 12 projects to look at, and some were for 2 years, some were for 5, some were 10-year lived projects. Well, to help equate those projects, you can do something called an equivalent annuity. And it would have worked particularly well with the effluent water. But here's another example. So let's say you're going to have to introduce an air cleaner. The expensive one, the Cadillac cleaner, costs $4,000 today and has operating costs of $100 and lasts for 10 years. The cheap one only costs $1,000 today, costs $500 to operate, so higher operating costs, but lasts for 5 years. If you have a 10% discount rate, which should you choose? So you can do this problem. You can figure out the present value of the Cadillac and the present value of the cheapskate, and because it's a cost, you want the one that with the lower present value. And when you did that, if you did this analysis, you would see the present value of the cost of the Cadillac is $4,600, whereas the present value of the cheapskate is $2,895, so the cheapskate would be the better deal. However, the cheapskate project only lasts for 5 years. At the end of 5 years, the EPA is going to require you to continue to have air cleaners. And so at the end of 5 years, you're going to have to put another cheapskate on or then go to the Cadillac. So what you want to do is, since the Cadillac lasts for 10 years and the cheapskate's only for 5, how do you equate their lives? So in essence, at the end of year 5, you would spend another $1,000 on a cheapskate air cleaner that would cost $500 per year for the next 10 years and figure out which one is overall cheaper. And when we do that, when we compute this equivalent annuity, then you can determine the present value of the cash flows. When we do the Cadillac air cleaner, if we spent $4,000 today and we had additional costs of $100 each year, which is a payment, and the life is 10 years at an interest rate of 10%, the NPV is $46.14. We then convert that to say, well, if the NPV is $46.14 on a 10-year project with a 10% rate, what is the equivalent payment amount? That's how you get an equivalent annuity. And the equivalent payment is $750.98. And what you want on a cost project is the project with the lowest payment amount. So for Cadillac, that's $750.98. For cheapskate, we did the same thing. Remember, we had an initial cost of $1,000. It was going to cost us $500 per year, but only for 5 years. And then we have a 10% interest rate, so our NPV was $2895.39. We now make that our present value for a 5-year life project with a 10% rate. The payment amount here is $763.80. And remember, with the Cadillac, it was $750.98. So although the Cadillac appears more expensive up front, when we equate the life of these two projects, the Cadillac is actually less expensive. So keep in mind, when you have projects that are going to be ongoing, that once one wears out, you're going to have to replace it. You can calculate what's known as an equivalent annuity in order to determine what the real cost is to the company over the equivalent time frame. The last thing in this chapter is inflation. We mentioned up front with the Baldwin case that I think the inflation rate was 5%. And inflation is important, especially if you're in economies with crazy inflation rates. We have what we call the nominal rate, which is the rate that you see. The real rate is your spending rate. And the nominal rate, the real rate is essentially your nominal rate minus your inflation rate. It's important, but we capture those rates when we calculate our weighted average cost of capital. So you do not take a capital budgeting analysis, and you can presume that your sales price is going to increase, and you can presume your costs are going to increase, but you don't add additional increases as a result of inflation. We capture inflation elsewhere. So if they tell you that an inflation rate is such and such, ignore it, because it is incorporated within the price increases on the sales item. It's incorporated within the cost increases, and it's also later incorporated within your cost of capital. So we do not add any additional inflation rates in there. We would be double counting inflation. So that's why we in essence we essentially ignored that earlier on. Okay. We're going to do a couple of problems now. And so I'd like you to take a moment and take a look at problem 6 at the end of the chapter, and take a moment to look at that, and then we will walk our way through problem 6 as well. Okay, problem 6 is a cost savings problem. So we're going to spend $530,000 initially. We're going to depreciate on a straight line basis. Yay, that's nice easy depreciation. And it's going to be depreciated fully over the 5 years, but there's going to be a salvage value at the end. When we hear that right away, we know there's going to be a salvage value, that's going to be a cash inflow, but I'm going to have to pay some taxes, because if it's fully depreciated, the government didn't receive as much in taxes as they would like. Now, this problem doesn't tell me about sales and costs and such. It just says there's cost savings. So this is a cost savings problem, which tells me sales less costs are $186,000 savings per year. And unlike our earlier problem where we had to spend on working capital initially, this one gives us a working capital savings initially of $85,000. But much like the earlier problems, when we save working capital initially, we have to pay that later on. So we owe that money later on. And our tax rate is 35%. So here's what we know. Let me build it out for you, because it's a little bit easier to see this way. Okay, so we have cost savings of $186,000 each year. Our depreciation, remember the cost of our machinery was $530,000. Straight line depreciated over 5 years. We're going to depreciate 1/5 of it per year. So depreciation is $106,000. Our operating income is the difference between those two. So that's essentially our EBIT. So our EBIT would be $80,000. And look how lovely this problem is. This is why Baldwin helps you appreciate other problems. The numbers are the same for all 5 years. When we're straight line depreciating and the cost savings are equivalent through time, it makes the development of the problem quite a bit easier. The taxes are at 35%, I think they were. Let me just check to make sure. Yeah, tax rate's 35%. And so then my net income number becomes my operating income less taxes to get to my net income number. Net income is nice, but remember we need operating cash flow. And our operating cash flow is our EBIT. Change some colors so you can see a little bit better. It's our EBIT plus our depreciation minus our taxes to come up with our operating cash flow. So it would be operating income of $80,000 plus depreciation of $106,000 to get us $186,000. Subtract out the taxes of $28,000 to come up with an operating cash flow of $158,000. So what do we know? We had to expend $530,000 initially. We were going to save $85,000 in working capital. So our cash flow initially becomes $445,000 outflow. So remember, we spent $530,000 to get these cost savings, but we were able to save working capital right up front. Okay, and then we have our positive operating cash flows each year, over $158,000 each year. Now in the fifth year, there's almost always cost recovery. So remember, we saved $85,000 in net working capital initially, so that's going to cost us $85,000 in putting that working capital back at the end of the life of the project. For our capital expenditure here, remember we had a salvage value of $50,000. Our tax rate was 35%, so we had to pay taxes of 35% or $17,500, which gets us to our after-tax salvage of $32,500. So our initial outlay was $445,000. We had positive cash flows of $158,000 each year for 5 years. Plus, at the end of the life, we had to spend $85,000 in replacing that net working capital, and we had $32,500 in after-tax salvage value. So our cash flow in year 5 becomes $105,500. We're asked to calculate the IRR, so we do that by looking at this line J that's buffeted by the 2 blue numbers at the moment, and we use a guess of 10%, and we have an IRR of 20.68%. Is that good? Well, somebody has to tell us what IRR number is good in order for us to go forward, and if indeed it's above that number, 20.68 sounds like a pretty nice number, so we presume that probably is a positive IRR project. Regardless, what we say to our boss is if we undertake this project and spend $530,000 to start this project, we're going to end up with earning a rate of 20.68%. Okay. Now take a moment and take a look at problem 9, also at the end of chapter 6, and then work through the problem, and then I'll show you the outcome of that one. Okay. Now problem 9 is a pretty straightforward NPV problem. And nicely, there's no salvage value, which makes it easier. So we have an initial outlay of $3.9 million. And if we spend this $3.9 million, we expect to generate sales of $2.35 million per year. We're going to depreciate that initial investment of $3.9 million straight line for 4 years over the life of this project, depreciate it down to 0 with no salvage value. We have sales of $2.35 million, and our operating expenses are going to be 25% of sales. We have to spend $150,000 in working capital initially, and we expect to recover all of that at the end of the life. Our tax rate is 35%, and we require a 13% of return, and we're going to calculate our NPV. So here, what do we know? So we start by building our income statement, just like we did with Baldwin. And we start with our initial outlay. We have to spend $3.9 million for this piece of machinery, and we have to spend $150,000 in order to build up our working capital. So altogether, we're going to expend $4,050,000 initially to get this project off the ground. So that's our initial outlay. Okay, so our operating cash flows, we're going to bring in sales of $2.35 million per year. Our costs are going to be 25% of that, or $587,500. Use some coloring here so you can see where I am. Your depreciation, you bought an asset worth $3.9 million. You're going to depreciate it straight line for 4 years, which means you're going to depreciate 1/4 of it, or $975,000 per year for the 4 years. That gets us to our earnings before interest and taxes. It's our sales less our costs less our depreciation to get to this $787,500. Our tax rate was, I can never remember tax rates, 35%. So our taxes are 35% of that $787,000. So our taxes are $275,625 to get to a net income of $511,875. That's the net income on our pro forma income statement. We need to convert net income to operating cash flows. Remember I told you you're going to be able to say this formula in your sleep. We use it all the time. It's EBIT plus depreciation minus taxes. So that would be this $787,500 plus depreciation of $975,000 minus taxes of $275,625 to get to operating cash flows of $1,486,875. So when we're setting up our spreadsheet, we have an initial outlay of $4,050,000, which was the piece of equipment plus the $150,000 in build-up and working capital. We have operating cash flows of $1,486,875 per year for 4 years. Plus, in the 5th year, remember we built up that working capital of $150,000 in year 0, so we had to spend $150,000. We recover all of that in year 4, so we get back. In addition to the operating cash flow of $1,486,875, we have an additional inflow in the last year of $150,000. So our year 4 cash flow actually becomes $1,636,875. So that's our cash flow stream, and we calculate our NPV, and it turns out that our NPV, given our discount rate of 13%, our NPV is $464,664.86. So what you say to your boss is if we expend this $3.9 million today, and we run this project for 4 years, given that the riskiness of our cash flows require that we earn a 13% rate of return, we more than earn a 13% rate of return. We're going to generate additional value for our company after taking into consideration all costs and all risk of $464,664.86. This is a good project, and we should go forward. Okay. Now let's take a look at problem number 20 at the end of the chapter, and we will take some time to work through that one, and then pop back on and look at the solution. Okay, with problem 20, I hope you begin to see just how very useful finance can be if you're trying to make your point on if you want to justify your rationale for a project. So in this case, we're looking at expending $415,000 for a piece of machinery, and we expect the machinery will work for 5 years. We're going to depreciate it straight line down to 0, so a fifth of it will be depreciated each year. But at the end of the life, we expect to have a salvage value of $50,000. So according to our books, the asset is worth 0, but we're expecting we're going to get $50,000 for it. So that would be a capital gains, which means we have to pay taxes on that capital gains. If we undertake this project, we're going to save $120,000 in salaries. So this is, again, it's a cost reduction project. And we're going to reduce our working capital by $80,000. Remember, if you reduce it initially, you're going to have to recover it in the last year of the project in year 5. Our tax rate's 34%, and we're requiring a 9% rate of return. So here we go. So we're going to spend $450,000 initially, but we save in working capital of $80,000. So our total initial outlay is $335,000. Now we're going to save $120,000 in salary. Our depreciation is, is it a 5-year life? Yeah, is 1/5 of $415,000 is our depreciation expense. It's depreciated straight line over the 5 years, so our depreciation expense is $83,000 per year, which gives us an EBT of $37,000. Our taxes are at a 34% rate, so we get $12,580. So our net income is $24,420. Now that's great. We've got pro forma net income. Now we need to convert that to an operating cash flow. EBT of $37,000 plus depreciation of $83,000 minus taxes of $12,580. Gets us to this $107,420. So our salvage value, we had $50,000 in salvage, but according to the IRS, the asset is worth 0, so we owe taxes of 34% on that, or $17,000. So our after-tax salvage value is $33,000. So what do our cash flows look like? Spend $335,000 initially, so we have an outflow. The purchase of the machinery offset a little bit by the savings in working capital. We're going to have positive operating cash flows of $107,420 for 4 years. And in the 5th year, in addition to that $107,420, we also are going to receive the positive salvage value, but we have to subtract out that working capital. So we saved working capital initially, so we have to throw it back in there at the end. So in year 5, our cash flows are the $107,420 for the operating cash flows. $33,000, sorry, in salvage value, and $80,000 in net working capital subtracted out. So it's a positive $107,000 plus $33,000 in salvage minus $80,000 build up in working capital. So when we calculate our NPV based on the given rate, we come up with an NPV of $52,279. So what do you say to your boss? If you spend $335,000 today, given all of the riskiness and taking all the cash flows into consideration, we're going to end up on the positive, better off by $52,279. So this is a project that should be considered worth pursuing. Okay? All right, I want you to do one more with us together. There's lots of good problems at the end of this chapter, so by all means, feel free to try other projects and problems and send them to me and let me check them for you. But I'd like you to also take a look at problem 28 and work through that one, and then let's take a look at it. Okay, I changed my mind. 28 is the problem we're going to go over in class, so please work on 28. It's the closest to Baldwin. We've done 3 easier problems. 28 has changing sales and changing costs and changing depreciation schedules each year. So take a look at number 28 and work your way through. The depreciation schedule for that time period can be found on page 176. So that will give you the accelerated depreciation for a 7-year project. And it's a good challenging one. So if you can do 28 well, you're in great shape in terms of understanding how to do capital budgeting. So look at problem 28. We'll start with that in class, and then we'll jump into chapter 8. Have a great rest of the day.